In this lesson, we're going to talk about how to analyze and record a merchandise inventory adjustment on a worksheet. Before we get started, let's talk real quickly about some terms. First term that is really important to know is actually merchandise inventory. The amount of goods on hand for sale to the customer is called merchandise inventory. Merchandise inventory is an asset account and it has a normal debit balance. Merchandise inventory account must be adjusted when you are ending the fiscal period. It needs to reflect the changes resulting from purchases and sales during the fiscal period. Basically, merchandise inventory will be related to the purchases account and also the revenue account, as we will get into later. When you analyze and record a merchandise inventory adjustment, you need to, at the end of the year, merchandise is oftentimes counted and to determine how much is on hand at the end of the year. The merchandise inventory account must be adjusted to represent the current value of the merchandise on hand. The amount of the ending inventory is the amount that must show on the balance sheet at the end of the year. And the difference between the beginning merchandise inventory and the ending inventory will be transferred into income summary. Merchandise inventory does not have a contra expense account, but rather it does close to income summary, as we'll talk about in a second. Merchandise inventory is used to adjust the merchandise inventory account at the end of the fiscal period. So these adjustments are going to be very similar to what we learned in the last lesson as far as when we record an adjustment. But you'll see real quickly that it's very similar, but there's just two different accounts that we're not used to, that we haven't had experience with yet. So the first thing we want to do is you see this transaction up here, and we say from a physical count on a merchandise inventory, the December 31 balance is determined to be $226,776.38. Analyze the merchandise inventory adjustment and enter the adjustment on the worksheet. Well, first thing is this. What is the balance of the merchandise inventory? We need to know that. Well, where do we find that? We find that when we go back to our worksheet in the trial balance column, and you'll see that the merchandise inventory account here is $236,314.63. That's what the beginning balance was at the beginning of this fiscal period. What should the balance be? Once again, a very similar question to the last lesson we did. And the balance should be, it's up there in the transaction, should be $226,766.38. So then now we need to ask ourselves what must be done. Well, if you look at this, if we started with $236 some odd in merchandise inventory, we ended with $226 some odd in merchandise inventory, it's pretty obvious to see that it decreased. And that's a good thing, because ultimately we've sold and we have more. It could potentially pertain to more cash. So we will take the beginning amount, we will minus it from the ending amount, which is the 236 minus the 226, and we found that basically we sold, we used or sold $9,548.25 of merchandise inventory. So now we've asked these four questions. Now the final question is we need to put it into a transaction, and what accounts will be used? Well, the first account that's going to be used, as we talked about earlier, is the merchandise inventory account. Merchandise inventory account, we said, is an asset account. It does have a debit normal balance. And then income summary will be the other one. Now, there is no expense account. We use income summary. Now, if you remember from previous chapters, income summary does not have a normal balance. Rather, the debits equal expenses and the credits equal revenue. That's kind of key there. It's a temporary account that will ultimately get closed. So for this balance, what we're going to do, and this is a little tricky, we started with a balance of $236,314.63. Our transaction told us that we ended the fiscal period with $226,776.38. So we need to make the difference. And as we talked about earlier, we need to decrease merchandise inventory. Well, the way we decrease merchandise inventory, because it's an asset account and it has a debit normal balance, it will be decreased with a credit entry of the amount that was sold / used, $9,548.25. Our contra account to that is going to be then an expense account. It's going to be the expense side of the income summary account, or a debit entry to income summary. When we move to the worksheet, we're done dealing once again with the trial balance columns. We're only using that as kind of our starting point. We're going to use the adjustment columns, and you'll see that in the credit column for merchandise inventory, we'll put a $9,548.25, and we'll put a $9,548.25 debit entry in the
adjustments column for income summary. The thing is, once again, why did we not put $226,766.38? The reason being is, as we move to the balance sheet, that number will show because we will take the beginning balance of the trial balance minus the adjustments, and that will get us to the balance sheet. So that's why we have not used the $226,766.38 yet, because that will ultimately show up in our balance sheet columns when we complete the worksheet. Hope this helps, and happy accounting. Oh, before I get going, one last thing I forgot to mention. If the ending inventory is greater than the beginning inventory, then entries are reversed. So in this case, if let's say the beginning balance was $236,000 and then the balance should be $246,000, instead of a credit entry that we have here, it would actually be a debit entry, and then you would also see income summary would be the entries would be reversed if there was a larger one. So